Yeah, the market is right. Let's put it this way: the market is always right because no matter what we think, or no matter what we think the market should do, our P&L is only determined what the market does. It doesn't matter if the market is wrong. The market is wrong. That's the truth, kind of thing.
Yeah.
It's like, and we've seen that is something that is very hard to accept. But the market is wrong. The market is right even when it's wrong, because our P&L is determined what the market does. Our job as a money manager is not to find truth. It's not to figure something out. It's not to figure out events or to predict events or to predict earnings or to predict fundamentals. That's not the job. The job is to predict prices.
Yep.
And when we do all the fundamental work, what we're trying to do is to predict future prices. But the problem is that there is a lot of market participants for whom fundamentals are not a factor.
True. Yeah.
So the market will behave according to the blend of all these market participants. Some of them will be fundamental players, some of them will not. And some of them will be fundamental players, but they cannot act on it, for example. So that will be the blend. So our job is to understand all these things that get reflected on the price. And even if our fundamental analysis is correct, if everybody else is getting something else, that's the truth. So the market will be right, even if it's wrong. So
the other major complication that I always struggle with discretionary, discretionary macro or discretionary value investing, traditional analysis of company fundamentals, that sort of stuff, is that it takes a lot of effort to dig into the fundamentals of a company, to get to know the company, to meet the management, to call the suppliers and call the clients. It's all, this, you have to sort of build a file and get to know this company, and getting to know it and spending time with it makes you emotionally invested in it. And, if you're going to devote a huge amount of time to something, it's really hard to let go.
Exactly.
When it doesn't really go your way, right? And I think of all of the potential challenges to any kind of discretionary thinking in markets, I think that may be the hardest one, because no matter how smart you are, and how big your team is, and your edge, most people believe they have an edge and actually don't. If those who do have an edge, the edge is something on the order of maybe 51 or 52%, right?
Look.
So 52% edge is actually a really substantial edge, so long as you're trading, sufficiently high turnover.
Yeah. I can tell you from experience, personal experience, and what I have seen others. When I was a value guy, when I was a fundamental investor, I was very arrogant.
It's almost required. I mean, you need
you're
to
right.
have a
Emotionally,
sense of overconfidence in order, because a foray into the market is an expression of your overconfidence that the market is in fact has not realized some set of facts that you have realized ahead of the market.
I was a smart person.
I think you're still smart. I think
was
you're still
too.
smart, Marcus.
So
it's smart until I realized how dumb I was.
It is an arrogant approach when I thought about it, and it's difficult for the two reasons that you said, Adam. One, imagine it's very, very hard to get all the information. But the thing is that when you get all the information, you may still be wrong. And I sometimes give this example, like if in 2000 you knew what Amazon's earnings and cash flows and everything, all the fundamental metrics, all of them for the next 20 years, if you had perfect foresight, which you didn't have, but imagine you had, and you said, this is a company that is going to do really, really well over the next 20 years, and you bought it, you were still down 90% in the meantime.
A couple times.
Yeah. So that was kind of useless knowledge.
Yeah, the journey matters.
Yeah, like even if you had perfect information and you were down 90%, you will think like, okay, this doesn't work.
Mm-hmm.
Now, imagine if you didn't have perfect information and you didn't, and we were down 90%. It's like, it's just not possible. So even when you have all the information, you may still be losing 90% of your money. I mean, that's not a great method.
Yeah.
If you think about it.
It's not successful when you have other people's money and transient capital.
Exactly. That doesn't work. So that's one difficulty. And the other one, exactly what you said, when you have invested so much time and effort into an idea, first of all, it's very hard to not, let's say you're interested in some name, you spend 3 months working on it. It's very difficult to say, you know what, all these 3 months that I did, let's not buy it. I mean, some people do that, but it's really hard to do that. And then when you're in it and it's just not working, and imagine you're in this Amazon, you're down 10, 20, 30%. It's like, it's really hard to let go, as you say. So this is a cognitive bias it's present in all of us. We are wired to do that, to hold on to what this sunk cost. And that's very dangerous. It's very, very difficult because of that. Now, the systematic approach gets rid of that and focuses on what is really important, which is the management of the trade once you have it on. And if you have a systematic, disciplined risk management process, you can even take random trades in equities in particular, because they trend. You could take random trades and keep the ones that are working and get rid of the ones that are not working, and ultimately you will make money. Now, taking random trades is not really ideal, but if it works on random trades, if you improve your trade selection, then you'll make even more money. The way I did that is basically the best indication that a business is doing well is that it's doing well. Same thing with a stock. Stock can go up for many reasons, but the best indication that a stock may continue to go up is that it's already going up, because that gives us good odds that something good is happening. It can be a good operator, good technology, a fad, whatever. But a stock that is trending up, stock or a commodity or anything that is trending is a reflection of a change that is happening. Change tends to be gradual. It takes time. It's just diffusion of information. When we see a trend, chances are that the trend will continue.